Welcome to Algotrading, where we uncover the stories and strategies behind trading success. Have you ever wondered where candlestick patterns and trading indicators come from? These tools didn't just appear overnight, they're the result of centuries of innovation and brilliant minds who studied the markets. Today we'll explore the fascinating history of candlestick patterns and trading indicators and how they became essential tools for traders worldwide. Let's dive in. Before there were computers or even Western stock markets, there were Japanese rice traders. In the 18th century, a rice trader named Munehisa Homma developed the candlestick charting technique. His goal? To track the emotional psychology of buyers and sellers in the rice markets of Osaka. Homma's insights were groundbreaking. He realized that market prices weren't just about supply and demand, but also about the emotions driving traders. The candlesticks represented these emotions, showing patterns of fear, greed, and uncertainty. Each candlestick tells a story. The body represents the price range between the open and close, while the wicks, or shadows, show the highs and lows of the session. Patterns like the Doji, hammer, and engulfing are still used by traders today to predict market movements. Although candlestick charts were a staple in Japan for centuries, they didn't make their way to the Western world until the late 20th century. Steve Nison, an American technical analyst, introduced them in his book Japanese Candlestick Charting Techniques in 1991. Nison's work popularized candlesticks globally, transforming the way traders analyze markets. Today, candlestick patterns are a universal language for traders, whether you're trading stocks, Forex, or crypto. While the Japanese were mastering candlestick charts, Western traders were laying the groundwork for technical indicators. In the late 19th century, Charles Dow, the founder of the Dow Jones Industrial Average, developed the Dow Theory. Dow believed markets move in trends, and that these trends could be analyzed to predict future movements. Though he didn't create specific indicators, his work inspired the development of tools designed to measure trends and market sentiment. In the 1920s, Alfred Cowles and other researchers began using moving averages to smooth out market noise. By averaging prices over time, moving averages help traders identify trends more clearly. Today, moving averages are a staple for traders, with variations like exponential and weighted moving averages refining the original idea. In 1978, J. Wells Wilder revolutionized technical analysis with his book, New Concepts in Technical Trading Systems. One of his most famous contributions, the Relative Strength Index, or RSI. The RSI measures the speed and change of price movements, helping traders identify overbought or oversold conditions. Wilder's work remains a cornerstone of trading strategies worldwide. In the 1980s, John Bollinger introduced a game-changing concept, Bollinger Bands. These bands use standard deviations around a moving average to measure market volatility. When prices approach the upper band, they're considered overbought. When they touch the lower band, they're oversold. Bollinger Bands are now a go-to tool for assessing market conditions. Gerald Appel, a money manager in the 1970s, created the Moving Average Convergence Divergence, or MACD. This indicator tracks the relationship between two moving averages of a security's price. The MACD is especially popular for its ability to combine trend following and momentum in a single tool, making it versatile for traders across all markets. Did you know one of the most used trading tools comes from the 13th century? Leonardo Fibonacci, an Italian mathematician, introduced the Fibonacci sequence, which traders later adapted to predict retracement levels in markets. These levels, 23.6%, 38.2%, 50%, and 61.8%, are used to identify potential support and resistance points. Talk about timeless innovation. Today, indicators are more advanced than ever. From Ichimoku clouds developed by Japanese journalist Goichi Hosoda in the 1960s, to proprietary indicators created by hedge funds, technology has pushed trading tools to new heights. Now, traders rely on AI-driven algorithms and machine learning to create indicators that adapt to market conditions in real time. The possibilities are endless. From the rice markets of 18th century Japan to the AI-driven trading floors of today, candlestick patterns and indicators have come a long way. These tools are more than just numbers and lines. They're the legacy of visionaries who shaped how we trade. Which candlestick pattern or indicator is your favorite? Let us know in the comments. Don't forget to like, subscribe, and hit the bell icon for more trading insights. Until next time, happy trading.